business expense. Hello and welcome everybody. We're going to let you stream in right now. I am J.Thelander and glad to be here with Christine Leon-Connors. Christine, how many years are we going on here? It's multiple decades.
Multiple decades, even though we look too young for
Yeah.
that.
Well, I'm coming to you from up in the Blue Ridge Mountains in North Carolina. I pre-game to get up here for Memorial Day, so it is a slight chance that my screen will freeze, and then Christine is going to ride the in between if I look like something happened. But hopefully that won't be the case. We had Spectrum up here to upgrade over the weekend. So without further ado, Christine, I'm going to turn it over to you to introduce yourself. I'm going to introduce you just for 2 seconds in that you are the wealth management advisor and expert, I would say globally, but really in the United States. And you had an illustrious career at JP Morgan, which is where we work together. But your, knowledge and insights for private companies, founders, executives in terms of sort of what they own and how they own it, and maximizing wealth and minimizing taxes, which is the crux of today's discussion, is really unparalleled. But maybe you can bring us up to speed to where you are now as a founder yourself.
Thanks, Jody. I'm super excited to be here. It's incredible to think about how long we've been doing this. And it's so fun to be back again. It's great to see all of you in the audience. As Jody mentioned, I spent about 22 years at JP Morgan advising entrepreneurs and executives out here in Northern California. And then in 2021, I left to go run a smaller multifamily office investment firm spun out of Iconic. That was incredible. We grew that business over the following 4 years, and then we sold it to another firm. And then it was a moment in time where I had this opportunity to be a founder, be an entrepreneur, and really create something pretty incredible, just given the pace of technology, given what we see is missing in the market. We kind of say every client still manages their wealth with a spreadsheet. Every client is still trying to figure out what they own, where it sits, how they own it, and you can't really have a strategy or a plan for compensation, for taxes, for investments if you can't see everything in one place. And so my co-founder Kelly, who used to be the CEO of JP Morgan's private bank, was recently the CEO of City National Bank. She was also leaving, and we decided to start up Verita Strategic Wealth Partners. As of July, we'll be a year old. We have 10 employees. We're in Jackson Square, although I'm working from home today because I've got some meetings here in the neighborhood. And we've just built an incredible team, but really our offering, right? Our thesis is we are starting with experience. We're not a startup. We have incredible clients who have been supportive all along the way. But what we wanted to do first was architect our offering and take all of our expertise and make sure that we can build a scalable, sustainable business that doesn't need to be sold down the road.
Yeah.
So that's what we've done.
Yeah, so great. I'm going to just jump in with a little bit of data so that you can then guide us. Let's
Yep.
say you're with the private, this, we only cover the private markets.
Yep.
We also would like, since it's a nice sized group today and all high level, please feel free to put your questions in the chat. We've got Morgan who is monitoring, and we can certainly maneuver ourselves to answer whatever you would like to hear in more depth. But I'll start with a little bit of market data just to get us rolling. So just by way of background, most of you must know Thelander. I've been doing this for 30 years, covering the private markets on all aspects of compensation. So that includes private companies and the investors, so venture, private equity, and corporate venture. We have a great podcast. Christine has already been on it, called Caplander. We hope you subscribe. It's a lot of fun, and we keep it short and sweet because we know you're busy. In terms of the industries that we cover, it's the whole private capital markets, which is great. We're the only firm to still cover all industries, only private, and we run surveys, which are very much back in style because the payroll plugins and data coming from that is really sort of garbage in, garbage out, because many companies have different titles, title inflation, there's not just one way, and we really make sure that is done right. As we know, in today's world, the total financing is really off the charts. We've seen these companies that are raising, hundreds of $1 millions in their Series A. So I think that looking by instead of series of financing, the total financing is the best way to look at your compensation. And then I'm just going to run through a few other basic foundations here. Valuations, I'm going to let Christine touch on all of this. We've seen come and go. And in terms of your compensation, it can change what you're putting in for your, the cost of your equity. which does impact the whole narrative. Actually, maybe Christine, that is a good place to stop because I don't want to go too fast. So I'm a founder CEO, and I've raised, let's say, $200 million. So if we look at some data, which we will in a minute, and now I've been diluted down, and the valuation of the company has also fluctuated. So what happens with my planning? I come to you and I say, listen, I've got kids. How do I look at my compensation, and what's the discussion that you have?
Yeah, and it's so interesting. If we think about like Series A, Series B, Series C, those have gone out the window in terms of the different amounts of funding raised. And I think the dilution is a real one, especially with the amounts of capital being raised along the way. And I think the trade-off is really thinking about, cash comp versus the equity piece. And I've learned this from you, Jody, along the way, right? It's just the importance of, are you a founder or are you now compensated as an executive as well? And
Right.
what's that right mix
That's
that you
exactly
should
right.
have?
So we look at those different levers closely because we look at base pay, a actual bonus if it was paid, and total cash, which can be a combination of base and bonus, or it's just your base pay. And then we look at non-founder shares. So you're the executive that was hired from outside. And then in the founder bucket, we look at both founder shares as well as additional equity you get past your founder shares for the role that you're in. And that is very important because at some point we know your founder shares are going to get diluted and something needs to happen.
Exactly. Exactly. And so how do you think about your contribution both as founder and as operator and what that mix should look like?
Right. But what from like if the valuations and what is if I'm looking at my valuation has gone up and then gone down and there's an 83B election, how does all of that factor in? I'm going to give you an example. Here's some data, for example. Here is for, CEO compensation for life sciences only. So we took tech out, and you can see the different total. The bottom is total financing.
Yeah.
And this doesn't really change crazy enough. Even if you get over the 150 million, you get into a $500,000 of total financing, the cash will go up, but the equity you can see is very consistent. And this is the total founder equity has been diluted down. And then here's the same numbers at the 75th percentile. So I'm this person, I come to you. What do we discuss?
Well, first, we've talked about, the founder shares that you've received have been exercised. Chances are you filed the 83B and that equity just rides. And then it's kind of the question of what do you do with the rest of your equity package? How do you think about your ownership? And oh, by the way, if the valuation has changed, do
Yes.
you want to do some gifting? Do you want, because everybody really sees that up and to the right, there's always the risk that it doesn't go up and to the right. But there is also that opportunity when it does eventually go up and to the right is to gift some of those off your balance sheet and use that opportunity for planning. We kind of say there's three levers that you can think about on the tax side, right? There's estate tax, 40%. There's capital gain tax, depending on where you live in California, it's almost 14% for state, so you're looking at about 40% combined. And then there's the ordinary income piece, which in California is more than half. So how do you think about those three levers as it relates to what you own and the growth of your company and your equity on your balance sheet to minimize some of those strategies with the right planning tools? So we would map out everything you own, what the current valuation is, what's vested, what's not vested for some of you that have non-founder equity that might not be vested. And how do we think about kind of the path and the strategies that we can employ with those mix of equity, shares, ISOs, non-quals, et cetera, to do the right planning?
Well, that's the piece of it. I'm going to look into the different types of equity right here for a second because it's not only the amount, but what type of equity you own. And I would remark on how many times we do these conversations in these 30-minute webinar or lunch and learns, and we use a lot of the same data, but the conversation around it is different every time. And you're seeing that it's not only what you own, but how you own it. So first you got to know what you own. And you said the ISOs, non-qualifieds, restricted stock, they all have different tax implications, but they all have different planning in terms of what you're looking at your wealth management strategies.
Exactly. Exactly. And so some of it is what is even allowed, right? What is transferable, what is non-transferable, what has been exercised previously. ISOs versus non-quals have very different taxation around them. And thinking about the right mix, I also think it's just really important. This goes back to like, what do you own? How do you own it? And then what can you do with it? And really understanding those nuances is key.
We did have a couple of questions on chief medical officer data, so I'm going to show that. And I think showing the data is great, but this all comes from our comp planning tool. So as I said, we run good old fashioned surveys. They are run and open all year round. Morgan's going to put the link in the chat because it's a give to get model, which means you give us your data and we give you back your data for no charge on the platform. And then if you want to upgrade and purchase full access where you can run year over year data and other custom reports, obviously we charge for that, but we do give you enough just to be dangerous for no charge. And we actually are going to be coming back to publishing some yearly reports as well, because I think people like to see not only the data, but the analysis. But here's a chief medical officer. And it's interesting, this we're saying, by financing all industries, because it's crazy, these jobs across life sciences, how a lot of tech companies and AI companies also have these roles. But again, you can see the total cash continues to rise with more financing. And this is the founder total equity, which could be a combination of their original founder shares plus additional equity. And we break that down so you can look at, and that's a discussion to have because you want to make sure you're getting to your number, which seems very stable. And it's amazing how stable it gets as you move into the later stage of financing, around that 1% for a non-founder. And here's the 75th percentile, which is also at 1%. I think it's really important to see that. So the dilution is, real. And it's also making sure that you look sort of holistically at your compensation and understand the different levers, and then also understand where this fits in terms of your sort of comp structure and the whole component of option pool as it relates to the company. But then, are there strategies that you help a whole company with, or is it more on an individual basis?
It really depends. So like we just did some QSBS stacking for an executive suite, three founders and a CFO. And there wasn't just the basic, everyone's like, oh, I understand what qualified small business stock is. And with the recent change up to $15 million of tax exemption of gain,
Because it's
pretty
more,
incredible.
right? It's grown from what, 10
It's
million to 15
grown. It's
million?
15 million now. But what is really interesting that people don't totally know is it's 10x your basis. It's the greater of. And this particular company had flipped from an LLC to a C corp, and therefore it actually impacted their basis in a positive way for them to be able to offset more. So those little nuances I think are really important when you're working with someone across kind of the spectrum of expertise to help you think about the planning. But in that instance, we got them someone to do the valuation, the QSBS test. We helped do the gifting across all of the executives so that we could be super efficient with the planning on the T&E trust and estate law firm side. And then we put it in place on the same day across all those four executives. So we can be super efficient around the planning that we're doing and the advice we're giving at the kind of executive company level too.
I think the advice in the planning is the same as the comp structure. It is never too early to look at this, and it's never too early to make sure you get your comp right, because you can see the ripple effect on the wealth management and the strategies around wealth creation. Because if you miss certain opportunities, it's not always a now or never, but the earlier you do it, the better your optics are to be able to see.
And I would
Let's
also add too that it's not complexity, right? It's so interesting. I talked to another set of founders and they had done some QSBS planning, but to get the stacking, they'd already set up for trust. Well, they're still away from years away from a liquidity event, but now they have four trusts, four trustees in Delaware, four expenses every year, four tax returns. And there's other ways that you can do it in a more simplistic way. Just having that pattern recognition and expertise to have seen it done before, that's really what we bring to the table because we can keep it simple until it needs to be complex. And I think
we've had
that's,
some
our three
questions.
pillars are clarity, strategy, legacy, right? If you kind of roll all those together, it's like, you have to have some clarity, and then you have to keep it simple. along the way.
Yeah, we've learned this over and over. We do weekly data drops at J.Thelander in addition to our monthly digest. And we used to do all this creative like mixing of the compensation. And we've come to appreciate that the simpler and digestible the information is, the better everybody uses it. So we've had some questions on early exercise of options, like for a CEO in different, how often are we seeing it? And that's where we sort of fall into the consulting side because we can break this data down specifically for a company and their unique roles and how much capital they've raised versus series. But this is the allowing of early exercise of options, and that to whom do you allow? And you can see of the CEOs, it's 97%, other chiefs and so on. And then also, do you offer company loans for early exercise? So fill us in on what this means, Christine.
So interesting. I was just going through this with an executive last night, which is, it's rare. It's very rare, but it should be asked. If you are the
It's very
founder,
rare
if
that you can
you are,
early exercise.
it is rare. And this is what I love to see in your surveys, right? Like the tails are the ones getting it. The tails are also probably the ones asking for it. But generally, it's reserved for like in a recruiting sense, if you're bringing someone in from the outside, or if you are a founder. For example, this particular client is a founder, but was getting additional grants.
Yeah.
And because he's young, he doesn't have a ton of cash flow, but wants to start that 83B. We structured it so that it could be a loan from the company, and down the road, it could be forgivable,
Yeah. So we
right?
see
Because you
that all the
definitely
time.
want to
But
clean
in a
that up.
deal, yeah.
Yeah. Yeah. You see that, right? Where you make it forgivable as part of compensation down the road. Potentially, it's an expense to the company, but there's all the nuances around that. But the biggest recommendation we say is ask. And if
Right.
you're
Well, this
coming
is
in from
where we
the
see
outside,
differences in
leverage.
comp data
Yeah.
for first time, second time, third time
Yeah.
CEOs, because
Yeah.
ideally, as you get more experienced and you have successes, even if they're not like blown out of the water successes, then you know what to ask for. And invariably, if you don't ask, someone else is going to come in on your executive team who's being recruited from outside, and they are going to ask. So, what other things do you ask for? Early exercise.
Definitely the early exercise, obviously, so you can do the 83B. Transferability allowed within the stock plan to family members, so you can do the gifting.
Yeah.
That's an important one. Those are probably the two biggest.
What about like the full acceleration? Do you get into that?
Well, when you're negotiating your employment agreement, yes, we will
Yeah.
do acceleration upon change in control, single trigger, double trigger, and how you think about those scenarios, especially as you're seeing kind of M&A in addition to IPO markets, hopefully
When
heating
we
up.
talk to the lawyers, every lawyer is so crazy busy with M&A right now. So those transactions, as we know, are happening more than the IPOs. So,
Yeah.
and if you're heading towards an M&A, is there a different strategy than if somebody's heading towards a IPO?
Yes. Like if you're heading towards an IPO and you are a C-level executive, it is a hard time to be a public company CEO. There is reporting, there is public disclosure. Clean up your comp, maybe take some money off the table in the next round while you're still private so that you don't feel the pressure to have to sell in the public domain where everybody sees what you sell. I just talked to a CEO and founder of a company that has been doing this for almost 20 years and hasn't sold a stock, a single share.
Right. So
It's a lot.
there's no
That's a
liquidity
lot of
then.
pressure, right? And we always say that, being an IPO is not necessarily a liquidity event for a founder or a C-suite. So thinking about that along the way as your lead up to an IPO is really important. All your reporting requirements and all of that. If you're going down the path of M&A, there's certainly a lot of other strategies you want to be thinking about. Setting up the trust, the gifting. Is it going to be in cash? Is it going to be a mix of cash and stock?
Right.
Understanding what accelerates immediately upon changing control. It usually is everything, but they may want to not and have it roll into NewCo. So understanding a lot of that is really important, and we'll dive in and help clients there.
The truth of it is that the way you set up your compensation follows you through an M&A transaction.
Yeah.
Now, if you're in a positive M&A transaction, then you will probably get the equity in accordance with what you've already gotten, right? Like if
Yep.
you're
Yep. Because they want you to
allocated.
stay. Yep.
Right. What you got in the beginning. So getting it right is really important. And if the company is in an M&A transaction and they're underwater or there's distress, chances are the acquiring company will carve out a percentage of deal
Yep.
proceeds that have to go into retaining the top talent. But again, these numbers are very formal numbers. I'm going to show you the CFO data because this is really a job that you can
And I will
see.
say, Jody, having sold a company, it is truly not over till it's over with the diligence and the negotiations and like until it is signed, don't spend the money.
Right. Don't spend money.
Don't spend the money that you think you're going to make until the
Oh, I
deal
see.
is
Right. Not
done.
till the fat
Yes,
lady sings, right?
yes,
It's not over till
exactly.
it's over. That's perfect for me up here. That's like a country song. Okay, here's the CFO data talking. And we understand we have tech people as well. And in the tech world, you tend to look at things by revenue and valuation versus in the life science world, it's sort of laughable to look by revenue because there's likely no revenue. And that's not really a priority. It's more of where they are in clinical trials and commercialization and other components. But here's a CFO. This is year over year data. This is another tool that we have at Thelander that I think very useful to show the stability of the market from 22 to 23, 24, 25 to 26. Look how crazy stable this is. It's almost hard to believe that for the 23 all the way through 26, that the total founder equity is 3%. And since 2022, how stable the non-founder equity is at 1%. And then so this is median and total cash to 280, which I know everyone is saying is really low. And then here's the 75th percentile, which is showing even from last year to this year that the total cash is 375, and the equity is up to be a little bit more. So it's showing that the CFOs are getting paid more at the 75th percentile over the last couple of years because I think deals and financing has gotten to be very complicated.
Yeah. Yep.
Yeah. And then we talked a little bit about the equity grants. Maybe another place as we're heading into the last 10 minutes here. And again, if anyone has questions, please send them in because we're happy to swing our wagon in that direction. We cover over 300 positions in our survey. And we also look and see what premiums people are paying for the AI roles. And these AI companies are just moving so quickly. So what are you seeing in the difference between an AI company and you have less time because to do the wealth management strategies because A, the rounds are so much bigger, and B, they're moving very fast versus a company that's slogging through a little bit more.
Yeah, I think we're seeing a couple different things with the valuations as high as they are. We're using strategies like grant or retained annuity trusts for gifting rather than just a straight gift because everybody is limited at $30 million of assuming per couple of lifetime exemption, and so you don't want to use it all if it goes to zero. So there's definitely strategies where like a grant or retained annuity trust gifts away the appreciation, but keeps so it's essentially seen as a very low gift. There's other strategies that just don't have enough time that we can go into. Some of the other things that we are doing is also looking at ways to minimize the tax piece on your balance sheet. So for clients that may have taken a chunk off the table or clients that are vesting large amounts of equity, which you are seeing with a lot of these AI companies, that's generating a lot of income for them. But we then can say, okay, well, let's take that pot of cash and let's start minimizing the taxes through some interesting strategies to reduce the long-term gains of future sales.
Right.
So again, this goes back to understanding how the different pieces move across your balance sheet and your portfolio. And as we like to say, like, what are the different levers that we can be pulling? But there's a lot of interesting strategies that, 5 years ago didn't even exist
Right. Right. So
around
it's
the
not
different
and it
tax
really
strategies.
is. We had a question coming in about how often do you see, let me read it exactly. How often do you see founder CEOs receive an additional CEO option grant on top of their founder shares? I'm going to
Mhm.
show this data right now, which I think will give a little bit of context. So if you look at the option pool, which is typically 10 to 15%. And then these are the other components: reserved for future option plan, granted annually in refresh, and granted annually in new hire grants. And for a late stage company, as you would expect, the founders have gotten diluted and the investors own more. And you can see the employee pool is between 10 and 15%, and it stays that way the whole time. So the reality is that it depends. We see founders get additional equity past their original grant all the time. The question is whether how well you've set yourself up for what you need. I'm going to show you here. So here is CEO data. Let's just look at it a couple of different ways. So here is CEO real-time comp data for life sciences for a company that's raised 90 to $150 million. And you can see the non-founder equity very stable, median 75th. We had even put in the max because it's not an outlier. It's just the higher numbers, and there are other numbers around it. And then you can see the percent of fully diluted shares for a founder, and then the percent of fully diluted shares founder for their current job. So this is CEO here. And this is not a straight addition. It could be in addition to, as you know, added, but it depends on where you were. If you're at the maximum number and you still own 50%, I can guarantee you are not getting additional equity. If you are at the 5% and you get diluted down, like here's the evaluation. Here's if you started high and you get diluted down, you're going to have to get additional equity to even hold this. So it's all predicated on how good of a job you did in the beginning to look at data like ours. I'll toot our own horn because we have this, like, there's no excuse not to know what you should be getting and then what you should be keeping as you raise through dilution, because you're not going to get an anti-dilution clause. And if you do,
well, and this is where I've seen the data that Jody has super helpful because it helps you make the case and it helps you separate it from being an anti-dilution case to an impact on the business that you're having case and an operating CEO from a founder CEO. And there's definitely ways, Jody, I don't know if you have some of that data of thinking about it where you tie it to performance. Some of the vesting is accelerated if certain milestones are hit, especially if you're getting closer to, call it like a huge contract being signed or an IPO.
Right, so you can.
Like
So
there's
here's the
definitely
type of vesting.
milestones.
Right.
Exactly.
In general, it's a time-based vesting. But I agree with you, and this is all part of the strategies, is that you can put in time and performance-based is really more of the combination that you could have. And I know that it's trickier for investors to want to have the time-based vesting with the performance, but
And a lot of it depends on just the nature of the board and the friendliness. Like we're working with a company right now that, you know, is probably going to triple the valuation in the billions, and the CEOs and three founders are incredibly valuable. They
well, let's
will absolutely help them figure out, but a lot of it's also tied to acceleration with performance.
Let's talk about that for a second. It's a good way to wind up. What is the planning that you think, so much of this you're seeing is that you really have to be prepared. You need to plan. You need to have both your company compensation structure in place and then where you fall into it. And I think many CEOs, especially in the life science area or a first time CEO, are very reticent to push for their own compensation because they feel like it's greedy, which is absolutely not true because it level sets the whole organization. And then there's the piece where you've really got to be hyper aware of what your board needs and to be prepared and have those discussions ahead of time before you get to a board meeting and be have that planning so there are no surprises. So as you look out on the horizon, everything you've been seeing, I mean, we know in San Francisco, it's been crazy. We see all the articles around the real estate and all these people who've grown into wealth creation quick. What's your take on the market as you look forward right now?
It's probably one of the most exciting times we've seen, just in terms of the pace of innovation, the pace of change, the pace of wealth creation. I mean, there's trillions of dollars of liquidity about to hit the market. Huge amount of that here in Northern California, which is exciting on the one hand, and certainly great for the economy. Hard if you're trying to buy a house right now. But I would say to everybody out there listening, like get typically it's, and this is what we see all the time, like you don't want to focus on it, you got to focus on the company, that's what's driving your wealth, but then you pick your head up and it's too late. So have a great partner, whether it's myself or someone out there in the market that does this from a true advisory standpoint that you trust, that can help you look across everything you own, help you come up with a strategy. You go back to running your business and we typically just get all the planning done for you so that you can continue to focus on the business, but it's getting done because the acceleration and the pace at which this is moving.
It can happen so fast.
Yep. Yep.
Yeah, and it is, I mean, everyone is putting AI into their company some way, except the true life science companies that are not doing that because things are just sort of moving. They have to move
Yep.
where they are. And I think the thing of it is that why we're on this webinar together is we complement what you do. We make sure your house is in order in terms of making sure that you have the right amounts, that your company is set up with every kind of planning from your pay plans to your executive comp to your deck for your board. And then you got to reach over to Christine and her team over over at Verita, because you've also then got a plan to keep your house in order, because there's no reason to let this go too late and find out that you don't have the wealth creation because you didn't maximize your planning and the taxes and all the other components. We are right at 1:30 on the number here. We want to thank you for joining us. We will follow up with the video from today and contact information. And of course, again, our survey link, because we really want you to participate. And we hope everybody has a nice Memorial Day holiday. And thank you, Christine, as always, the
Thank you for
best.
including me. Great to
Yeah.
see everyone.